This is Retirement News Online. With proper planning, a retiree can keep their tax bill as low as possible during retirement. Here to discuss some ways to develop an efficient tax plan is my guest, Robin Whitlock, with Infinite Wealth Advisors in High Point, North Carolina. Robin, begin by talking about the difference between tax preparation and tax planning.
Tax planning is an integral part of the retirement process, and people tend to get confused between tax preparation and tax planning. Tax preparation is a retrospective view of what has transpired in the last year with the transactions that you've had financially. Tax planning is a comprehensive approach to retirement planning, whereas you take a look at your retirement income, things that could impact your retirement income, and you create a cohesive plan in order to be able to mitigate your tax burdens in retirement. Part of that process is we look at ways to lower your retirement income, increase your deductions, and take advantage of tax credits. That all of those things together help to decrease your tax bill in retirement.
Now talk about how the different retirement plans are taxed.
You have different options when making retirement savings decisions. Some of the ways that you can save for retirement, you can contribute to pre-tax accounts. As you're making those contributions into those accounts, you are not taxed on those dollars. You also have the ability to make contributions to accounts that are post-tax, whereas you pay the taxes prior to retirement. Depending on your financial situation or where you think you're going to be in retirement will determine which strategy you choose, whether you make pre-tax contributions or post-tax contributions. Either way, you need a competent tax professional to be able to help you make those decisions.
So how do you know if a Roth conversion is a good idea right now?
Roth conversions are good ideas if you anticipate that you're going to be in a higher tax bracket when you retire. Typically, when I make a recommendation for a Roth conversion, I'll start with a tax analysis. We'll look at where you are today with your current income. Typically, as you approach retirement, your income tax brackets tend to get higher. So if you're in a lower bracket today versus where we project you to be when you're retired, we make those recommendations to go ahead and make a Roth conversion now. And if you're like most people, tax brackets are only going to go up. So it does make sense in some instances to make those Roth conversions now. But before we make a recommendation to make a Roth conversion or not, I prepare a tax projection to help you make the best decision.
That's Robin Whitlock in High Point, North Carolina. This is Retirement News Online.